Okay, let's go ahead and do our first illustration of the consolidation of a wholly owned subsidiary which is acquired at more than book value. And we'll start with the simplest case where we're just going to do the consolidation at date of acquisition. For example, let's assume that on January 1st, 01, big company buys 100% of little company's outstanding common stock for $400,000. And let's assume that on that date, Little had a book value of $250,000. Again, that's either the sum of their owner's equity accounts or assets minus liabilities. And on that date, Little's assets and liabilities had fair values equal to their book values except for the following. First, we have inventory, which is undervalued by $10,000, and we'll assume that's accounted for on a FIFO basis, first in, first out. They have some land, which is overvalued by $20,000, and they have some property, plant, and equipment net undervalued by $100,000. And let's assume that has a 10-year life. Now, saying property, plant, and equipment net suggests that we're not going to have a separate accumulated depreciation account. We'll simply have property, plant, and equipment net on the balance sheet. The first thing we need to do is go through our cost versus book value equals differential analysis. And so the cost of our investment was $400,000. The subsidiary has a book value of $250,000 for a differential of $150,000. And again, that means that from an accounting standpoint, we paid $150,000 too much. Now, obviously, we paid fair market value, but again, from an accounting standpoint, we paid an extra $150,000 above and beyond book value. And the question is, why did we pay this premium? We have to explain away what exactly we bought for that extra $150,000. Now first, we have inventory, which is undervalued by $10,000. Now, since inventory was undervalued, that means that it's worth more than book value, and since the inventory was worth more than book value, that explains why we were willing to pay more than book value. So that explains away $10,000 of that $150,000 differential. Conversely, the land is overvalued. So just as we subtracted the undervalued asset, so we have to add in the overvalued asset. The property, plant, and equipment was also undervalued. And again, that means that the property, plant, and equipment is worth more than book value, which explains part of the reason we paid more than book value. So of the $150,000 differential, we have three things that explain that discrepancy. Whatever is left unexplained is going to be ascribed either to goodwill if the number is positive, or to a bargain purchase if the remainder is negative. Okay, so here's our cost versus book value analysis, and let's go ahead and prepare the consolidation at date of acquisition. Now, this means that we're going to be only combining the balance sheet accounts. Again, at the date of acquisition, there are no revenues yet, there are no expenses, there are no dividends. Now, previously, when we acquired a subsidiary at book value, basically we eliminated the subsidiary's beginning of year equity accounts against the parent's beginning of period investment. Now we need to expand this a little bit. In addition to eliminating the subsidiary's beginning of year equity accounts, we're also going to go ahead and revalue the assets and liabilities up or down to their fair value. Now, one additional little bit of information we need is the composition of Little's owner's equity. So let's go ahead and assume that Little's book value of $250,000 is comprised of $20,000 of common stock, $80,000 of paid-in capital in excess of par, and $150,000 of retained earnings. Again, I chose those numbers at random, the only constraint being they had to add up to $250,000. So let's go ahead and prepare our elimination entry for the consolidation at date of acquisition. And again, we start with what I refer to as our S entry. And as before, we need to eliminate the subsidiary's beginning of year owner's equity accounts. And now we're going to go ahead and revalue, either up or down, the misvalued assets and or liabilities in conformity with the analysis at the top of the page. So going through one by one, the inventory was undervalued by $10,000, so to correct that, we're going to go ahead and write up the inventory by $10,000. Now, this adjustment to the inventory account is not being made on Big's balance sheet, it is not being made on Little's balance sheet. It is being made in the consolidation worksheet. Similarly, the land was overvalued by 20,000. So to correct that, we need to go ahead and credit land to lower it by 20,000. And again, the property, plant, and equipment was also undervalued. So we're going to go ahead and debit property, plant, and equipment to increase that to its fair market value at the date of acquisition. And then finally, we're going to go ahead and create that $60,000 of goodwill. Again, the goodwill does not exist on Big's balance sheet nor on Little's balance sheet. It's being created on the consolidated balance sheet. Since the goodwill is not being recorded on the actual books of either Big or Little, that means that each and every year we're going to need to go ahead and recreate that $60,000 of goodwill as part of each year's elimination entries. That total of those 6 debits and 1 credit net out to $400,000, and that is our beginning of year investment in Little balance. Now we're going to need to go ahead and post this elimination entry to our worksheet. So again, here's the worksheet with Big and Little's balance sheets in the Big and Little columns. There's our elimination entry off to the right-hand margin, and now we simply need to post the debits to the debit column, the credits to the credit column. So first we post our 3 owner's equity accounts, eliminating Little's paid-in capital accounts and beginning retained earnings. And now we just go through those asset revaluations. We're going to debit inventory for $10,000. We're going to debit property, plant, and equipment net for $100,000. We're going to debit goodwill for $60,000, and we're going to credit land for $20,000. And finally, we credit the investment in Little for $400,000. Again, simply posting debits to the debit column, credits to the credit column. And now we add across each of our worksheet rows just as we did previously. Cash and receivables, there are no adjustments, so we simply add across. Inventory, as reported, was $50,000 for Big and $40,000 for Little, a total of $90,000. But again, Little's inventory was undervalued, and we wrote it up to its fair value. So we added $10,000, bringing the total to $100,000. As always, the investment in Little account has to go to 0. Property, plant, and equipment net, again, as reported, Big had $300,000, Little had $200,000, but Little's property, plant, and equipment was undervalued by $100,000, so we went ahead and took the liberty of increasing the reported property, plant, and equipment by that amount. It's up to a total of $600,000. Land was overvalued, so we're going to be reducing Little's land. So as reported, $100,000 for Big plus $40,000 for Little, a total of $140,000. We take away the $20,000 because Little's is overvalued, and we're down to $120,000 total. And then lastly, goodwill, we're placing that on the consolidated balance sheet at $60,000. Now, it's worth noting at this point that these adjustments to the asset values are being done only on the worksheet. We're not actually changing the ledger accounts for Big or Little. That means that every year we're going to have to come back and repeat this process. Every year we need to reinstate that goodwill, we need to reinstate that land adjustment, and we're going to need to reinstate the inventory and property, plant, and equipment adjustments. But since those have finite lives, those will be amortized a little bit later on in our discussion. Jumping down to the credit side, we add across the accounts payable, $100,000 plus $10,000 with no adjustments, $110,000. Likewise, the bonds payable, total $240,000. And then for the equity accounts, again, we're eliminating Little's owner's equity account, so we're left with the parents, or Big's owner's equity account. $50,000 of common stock, $130,000 of paid-in capital in excess of par, and $400,000 of retained earnings. Again, we've essentially negated or canceled out or offset all of Little's owner's equity accounts.